Well, it was a rough morning on Wall Street today as virtually every asset class across the board started selling off hard as soon as that opening bell rang after carnage from the unwind of the yen carry trade spread to Western markets. And very predictably, all of the Keynesian economists and the financial elites were marching out in the financial press today demanding emergency rate cuts from the Federal Reserve. Now, glossing over the fact that these financial elites are acting like a bunch of whiny little bitches who demand the central banks step in and rig markets so that their trades don't lose money every time things go against them, the sad reality is emergency rate cuts from the Fed here probably won't work, and they might actually make things much worse. What's up, guys? I'm Nobody Special, and what we saw this morning was a partial unwind of the yen carry trade. And we'll go through this really quick because everybody and their brothers out there talking about the yen carry trade today. But what's happened is for the last few years, hedge funds and rich individuals and banks have been able to go to Japan and borrow yen where interest rates have been very low and at times even negative. They've been able to borrow those yen and then convert them into dollars or euros and then go buy assets like stocks and bonds with those dollars or euros. Now, this trade has been very profitable because the earnings on those stocks and bonds has been much more than the interest rate that they've been paying on those borrowed yen. Plus, the yen has been falling very dramatically for the last few years, and so the yen that they owed have become less and less valuable compared to the dollars that they changed them over to. So this has become known as the yen carry trade. But recently, that has reversed. Recently, interest rates have started going down in the West with the Bank of England and the European Central Bank cutting rates. Also, the Federal Reserve is going to start cutting rates very soon. And Japan has started raising interest rates, so that difference between the arbitrage between the two central banks has started to shrink. And on top of that, the yen has started to strengthen against the dollar. So the money that you can make with that yen carry trade has been slowly going away. And that's caused people to start selling those assets they bought, converting from euros and dollars back into yen, and then paying back those yen loans. That is the unwinding of the yen carry trade. Well, as you sell those assets in the West, their values go down, and as you convert back into yen, the yen's value goes higher. So you have something of a feedback loop as the yen carry trade unwinds. It feeds on itself, and it starts to pick up steam, and that's what we saw in Japan last night, leading to a bloodbath in Japanese stocks. Now, the first real problem with using emergency rate cuts to try to bail out this collapsing yen carry trade and to try to stop the panic in markets is because rate cuts from the Federal Reserve are going to make the unwind of the yen carry trade even worse. Now, what you're seeing here is Christine Lagarde, aka Christine the Felon, the head of the European Central Bank. There's Kazuo Ueda in the middle, the head of the Bank of Japan, and of course, Jerome Powell, the chairman of the Federal Reserve. Now, right now, Powell is doing nothing, Lagarde is cutting rates, and Ueda is raising rates. So one of the reasons why the yen carry trade is unwinding right now is because of the divergence in the monetary policy with interest rates at the central banks. The Japanese are raising and the West is lowering, so the gap between those interest rates is getting smaller, causing that yen carry trade to get less and less profitable. And so the people are starting to unwind that trade. Now, what happens if the Federal Reserve steps in with an emergency rate cut of 50 or even 75 basis points that some of these schmucks in the financial press are calling for? Well, that'll make the gap between the Japanese and the Federal Reserve's interest rates even smaller. So an emergency rate cut right now might actually speed up the unwinding of the yen carry trade, which would make this sell-off in stocks even worse. Now, another reason why an emergency rate cut right now would be a very bad idea is because it would damage the Fed's credibility. And I know a lot of you are probably saying, what credibility? Obviously not very much left with me or with people watching this channel, but for some reason, a lot of people still have faith that the Federal Reserve has things under control. And one of the things that they've been using to tell people we've got this under control was this silly narrative of the soft landing, where the Fed manages to solve the problem of inflation without causing a rise in unemployment. And some of the big metrics that they've been throwing around have been their 2% inflation target, saying that, yeah, we can get inflation back down to 2%, sustainably so, but also that we can do that without causing unemployment to go higher than 4.5%. It's a number Jay Powell himself has used. So if 1 week after the Federal Reserve opted not to lower interest rates, they were to suddenly change their mind and panic cut interest rates, they would be telegraphing to the market that they don't really have this under control and that the soft landing has been a BS talking point all along. And you can see historically, every time the unemployment rate starts to turn upward, a few months later, it starts to spike dramatically. And you can see where we're at all the way over there in 2024 now. The unemployment rate has just risen to 4.3%, barely a hair away from that 4.5% target. And there's just no chance that unemployment is going to stop at 4.5%. Even if they do cut rates, it's just not going to happen. Unemployment is probably heading to 6%, maybe 7 or even double digits, depending on how bad this recession gets. And another reason why the Fed needs to be worried about their own credibility is, let's not forget this little buzzword from the last couple of years. Does anybody remember transitory? I'm still trying to forget it. The Federal Reserve told us after they printed trillions of dollars in 2020 and we all knew inflation was coming, the Fed said, don't worry, it would be transitory and it will be limited and inflation won't ruin your lives. And well, for 80 to 90% of Americans, that is obviously not true. Inflation started ripping higher. It went as high as 9%, way higher than the transitory levels that they told us we would see. And now with the average American still thinking about transitory and how wrong the Fed got it last time, and then thinking the Fed was also wrong about the soft landing, what do you think the average American is going to think if the Federal Reserve steps in now and makes an emergency rate cut? They're going to think inflation's probably coming back again. And you don't have to use your imagination to find out what that is, because we've seen this before. Now, what you're looking at in this chart here is the interest rate on the 10-year U.S. government treasury bond, shown in green and red. And then there in brown, you're seeing University of Michigan inflation expectations, or what the average person thinks inflation is going to do over time. And the point is, these two, they're not perfectly correlated, but they do exert force on one another. And in particular, inflation expectations tend to move before the 10-year Treasury yield does. In case in point, I want to show you in 2020, right, after the vid started, after the Fed started with their bazooka of liquidity and their money printing and cutting interest rates all the way to zero, you'll notice that inflation expectations started to rise almost immediately. But the interest rate on the 10-year government treasury, it started moving a few months later, because inflation expectations has a way of pulling long-term interest rates higher. And that makes sense when you think about it, right? If you think money is going to be worth less several years from now, then you're going to demand a higher interest rate in exchange for loaning money to the government for 10 years. And so as inflation expectations rise, it tends to pull up on the 10-year treasury yield. And that's important because you can see what inflation expectations did to the 10-year Treasury yield over 2022 and 2023. Now, we have seen inflation expectations have started falling since the Fed began their tightening cycle. And again, with a lag, we've now actually started to see 10-year Treasury yields start to fall with that. But if the Federal Reserve starts to cut interest rates on an emergency basis, when most people are already losing faith in the Fed because the soft landing narrative was fake and transitory was fake, and if everybody is still being crushed by inflation, what's going to happen to inflation expectations if the Fed starts cutting rates? Inflation expectations are going to rise just like they did in 2020, which means a few months after that, we're going to see long-term interest rates start to rise also. And so if the Fed isn't careful, cutting interest rates now could spike inflation expectations, which would actually lead to higher interest rates on the long end of the yield curve, which would further damage the economy by driving up long-term borrowing costs for things like mortgages and cars. So long story short, emergency rate cuts now would be a terrible idea. Not only would they make inflation worse, not only would they cost the Federal Reserve even more credibility, but they would be counterproductive because they would accelerate the unwind of the yen carry trade by further closing the gap between Japanese and American interest rates, and they would possibly spike long-term inflation expectations, which would lead to higher interest rates on the 10, 20, and 30-year Treasury, which would do even more damage to the economy. So the message is to all these financial elites and Keynesian economists who are in the financial press begging the Fed to change the rules to bail out their losing trades, the message is, shut up. You made a bad trade. Do what everybody else does. Take your losses and do better next time. You don't get to go whining to the central bank every time things don't go in your favor, making things worse for the rest of us. Shut up and take your losses. Till next time, live small and dream big.